I'm often asked, should I invest all of my money today? Should I time the market and try to do it over dollar cost averaging? This is one of the most important questions clients have asked me. Market timing is the strategy of trying to predict future market movements to make investment decisions before the moves in the market actually happen. It sounds great in theory, but can you truly do it and actually come out ahead? Let's look at some numbers. A recent Morningstar report found that fund investors missed out on about 1/5 of their potential returns over the past decade due to poorly timed purchases and sales. On average, investors earned an annual return of 6% on mutual fund investments, while the average mutual fund gained 7.7% annually. But it gets even more striking. Fidelity Investments showed that missing just the 5 highest days of returns in the S&P 500 index over a 43-year period would have reduced final returns by a whopping 38%. That's a huge impact from just a few days not in the market. Now, you might be thinking, what about professional market timers? What about hedge fund managers? What about those active fund managers that always seem to be beating the market? Well, a study published in the Journal of Financial Economics examined 237 market timing newsletters. The results? Less than 25% of the recommendations were correct. In fact, one well-known market timing advisor produced a 5.4% loss during a 13-year period where the S&P 500 index returned 15.9% annually. Here's a great story for you. In 2008, Warren Buffett placed $1 million bet that an S&P 500 index fund would beat fund of funds that hedge fund managers would select. Guess what? The Vanguard S&P 500 index, which he selected, yielded an astounding 125.8% return, whereas the returns made by the market timing stock picking hedge funds varied from a low of 2.8% to a high of 87.7%. Want even more recent evidence? In an article from the Wall Street Journal, they examined the return gap between the annual return of a mutual fund, since they most closely represent active traders' portfolios, and the dollar-weighted return, which incorporates money flows in and out of funds. For instance, from 2025 to 2019, the average return gap for investors in active U.S. large-cap stock funds was 0.37 percentage points per year. From 2020 to 2024, this return gap jumped to 0.83 percentage points per year. This means that since COVID, investors in U.S. large-cap funds have been leaving an extra 0.46 percentage points of return on the table, thanks to poorly timed trading. That return gap might seem small, but it's enough to negate some or all of the fund's fees, and of course, compounded over time, it could be a significant disadvantage. Let's just take a step back. Number one, investors have lost 1.7% according to Morningstar, 0.83% per year according to Wall Street Journal, and a 38% loss versus the index. So why do we consistently think we are smarter than everyone else? This is where behavioral psychology comes in. We're overconfident and we hate losing. We follow the herd, we seek information that confirms our beliefs, and we are emotional. Looking back to a video I did on Advisors Alpha, behavioral psychology alone can cost us 2% a year in returns. Put another way, with proper psychology, we can add up to 2% a year on our bottom line. Coincidentally, this is right in line with the articles I referenced earlier. Maybe instead of market timing, we should look at why we want to make moves in the first place. But for those who aren't convinced yet, let's see if we can help you with market timing. Here are a few reasons why market timing is incredibly difficult. Number one, markets are unpredictable and influenced by countless factors. Number two, by the time signals become clear to you, the market has usually already moved. And number three, emotional biases can lead to poor decision-making, especially during market volatility. Well, for most people who are watching this video, I can surmise that most of us aren't high-frequency hedge funds, and most of us get our information from social media, TV, newspapers, the internet, and word of mouth. So if you can't beat the market, what can you do to win? Instead of trying to time the market, many financial experts recommend a buy and hold strategy. This means investing regularly and staying invested for the long term, regardless of short-term market fluctuations. The most thorough paper on the subject, called Trading is Hazardous to Your Wealth by Barber and Odin, they mention that 20% of traders are considered active, which is 48 or more trades per year. The only problem is the date of the paper is actually April 2000. Since then, we've actually had an explosion of DIY investors, finfluencers, and a 24/7 news cycle thanks to social media. One can only imagine that active investors now represent more than 20% of the population. For those who buy and hold, congratulations. For those who are the most active and have a monthly turnover in your portfolio in excess of 20%, according to the paper, you are expected to underperform a market index by 10% annually. Yes, you heard that right, 10% annually. Let's sum it up. Number one, you can't time the market perfectly. You might think so, but behavioral psychology, data, and common sense are working against you. Number two, if you are actively managing your investments to try and time the market, multiple studies will provide evidence that says you are all but guaranteed to do worse than the benchmark. Number three, if you'd like to lose 10% a year, trade as much as you want. So what can you do? Find an advisor who has an evidence-based approach. Next, ask them about how they help clients through various emotions and market downturns. If you can find someone who gives you confidence, can give you financial planning, knows that they can't reliably beat the index, so they buy the index itself, and they give you the financial planning at a reasonable cost, you've found the holy grail of advisors. That's all for today, investors. Stay savvy, stay patient, and keep those long-term goals in sight.